Welcome to RANsquawk CE morning briefing for Friday the 31st of July 2009. Just going through 8:30. We'll take a quick look around the markets. First of all, recapping the major news from overnight. Starting off on the global front, some further commentary from the IMF following their comments on Europe yesterday. Now on the global front, the IMF says recovery is not underway, ending stimulus may be premature, according to the IMF's first biannual staff report on fiscal state of G20. US government debt in 2010 to almost match economy size, and at that the US, UK and Japan posting biggest 09 deficits in the G20. Most notable coming out of that report though from the IMF was that scrapping stimulus too quickly may hamper recovery, and that amount of stimulus funds spent less than the amounts that have been announced thus far. Elsewhere, one of the main focus points in US fixed income last night was the third auction of the week, the 7-year notes. That was coming on the back of the pretty poorly received 2- and 5-year, with the sharp downwards moves we've seen in treasury prices. Opposite reaction with last night's, the 28 billion was well received. The bid to cover there was at 2.63, just slightly shy of the previous and above the average for the 7-year issues. And indirect bids in particular, which have been significantly lower in the 2- and 5-year, maintained their previous height above 60%, coming in at 62.5%. Hence we saw T-notes finish up around 7 ticks or so at the pick close yesterday, and that has seen the likes of EGBs and gilt futures following suit, opening slightly to the upside this morning. In terms of elsewhere, other things of note in regards to that treasury piece was something in the Wall Street Journal saying that shaky results and notable Chinese absence at treasury auctions this week reignited concerns about whether the government can attract buyers from China and elsewhere to soak up trillions of new debt that the US will be issuing over the course of the next few months. However, the Heard It on the Street column writes that it is too soon to bury treasuries. A simpler explanation is that buyers faced with alternative demands on their cash are simply seeking higher yields on treasuries. And looking at the sales that we've had this week, that does come on the coattails of nearly 3 weeks of sharp gains in stock and credit markets that we have seen. So it could explain some of the reasons for that poor take-up in the earlier auctions we saw in the week. Looking elsewhere on the UK front, did have some data, the GfK Consumer Confidence Survey for July. It remained as it was previously at -25, not quite as good as we're looking at -23. British consumer confidence though holding steady. A small deterioration in Britain's expectations for their own finances was offset by a more upbeat view on the economy as a whole. And following those nationwide positive house price numbers that we saw yesterday, obviously the third increase in terms of third month in a row for UK house prices, the Lex column in the FT writing today that it would be somewhat remarkable if the British housing market really has stabilised, given that the economy is only 6 months into the steepest recession since the Second World War. Another possibility is that house prices have only found a resting ledge on the way down, and affordability is still a stretch for most first-time buyers, as according to the Lex column this morning. However, in the FX markets, cable is again trading up around 70 ticks or so, but pretty much more a product of the weaker dollar that we're seeing at the moment. Elsewhere then in stocks news, in China, the Shanghai Composite posted its biggest monthly gain since August of 2007 this morning. As a daily performance, it finished up 2.75%. Obviously, setting aside some of those fears we saw midweek when we saw that late sell-off after it was reported that 2 major US lenders may be putting capping size of their lending going forward. So the Shanghai finishing higher, and overnight the Nikkei also rose some 1.9%. Now it's its highest close in 10 months. And although the UK and European bourses did open lower, quite another raft of corporate earnings coming out. We are moving into positive territory, up around 0.2 in the FTSE CAC and DAX towards 9 o'clock now. Just capping a few of the major pieces, British Airways reported a Q1 net loss of £106 million. That was a deeper loss than expected at £95 million. And they see very difficult trading conditions. They are seen markedly lower this morning. Anglo-American, they are seen higher though. Their company's first half underlying EPS came in at 91 cents above the expected 67. And elsewhere in the CAC, quite a few companies reporting there. Total in particular, company's Q2 nets came in at 1.72 billion, broadly in line, but their Q2 production was down 7.3%. They are seen down around 2% or so. With Michelin also posting a first half net loss of 119 million euros. Analysts were looking for a loss of 270, so they're faring a little bit better. Also noting in terms of the banking stocks in Spain, something that came out after the market closed yesterday, hasn't had much of an impact in terms of their share price performance this morning, but noting comments out of rating agency Moody's, they said for both Banco Santander and BBVA that they've reduced their senior debt rating to AA2 from AA1. Looking ahead then for today, the main focus in Europe is going to be on the Eurozone CPI estimate and unemployment rate. They're going to be due at 10 o'clock. The unemployment rate in the Eurozone is expected to increase 0.2% to 9.7 today. And then the overall focus is going to be dominated by the US GDP report. It will be the Q2 advanced. We're looking at a contraction in the US economy of -1.5% against the prior contraction of -5.5%.